Stop. Put the phone down. Close every chart you have open on your screen right now. I need your full attention for the next 25 minutes because what happened this weekend is not something you process while scrolling. $15 trillion. That number is not a typo. $15 trillion was ripped out of gold, silver, and crypto combined over a single weekend. Not a month, not a quarter, a weekend. Friday through Sunday. Metals went first, then crypto followed. And by the time most people woke up Monday morning and checked their portfolios, the damage was already done. Mark here from GoFinance. And before we go any further, I need to be direct with you. This channel doesn't sell signals. We don't sell courses. We don't sell mentorship programs. We don't tell you when to buy or when to sell. What we do is dissect. We pull apart what actually happened in the markets. We look at the data from every angle, and we show you what the numbers are telling us. Not what CNBC is telling you, not what the headlines are screaming, what the ledger actually says. If you want someone to hold your hand and tell you it's going to be fine, this isn't that channel. If you want to understand the machinery, the real mechanics of what just happened and why, then stay with me. Because by the end of this video, you're going to understand exactly what $15 trillion disappearing actually means. And more importantly, you're going to understand who benefited from it. Let's start with Friday, because Friday is where this story begins. And Friday is where the smoking gun is. Silver cratered 31% in a single session. Gold dropped 13.5%. $7 trillion evaporated from the precious metals market alone. Not over weeks, not gradually. It was a vertical line on the chart going straight down. Now, the mainstream narrative is going to tell you this was about Kevin Warsh. It's going to tell you this was dollar strength repricing safe havens. It's going to give you a clean, simple, comfortable explanation that makes everyone feel like they understand what happened. And yes, dollar strength was a factor. That's real. That's a legitimate fundamental driver. But it wasn't the whole story. It wasn't even close to the whole story. Because the way this crash was executed, the precision of the timing, the coordination of the margin calls, the way physical markets in China and India responded, none of that fits the narrative of a simple repricing event. Here's what actually happened. On January 28th, the CME Group raised margin requirements on silver futures to 11%. That single action is the key to understanding everything that followed. Let me explain what that means for people who don't trade futures. When you go long a silver futures contract, you don't pay the full value of the contract up front. You put up a fraction. That fraction is called margin. It's basically a deposit. It's your skin in the game. Before the margin hike, speculators who were long silver at $120 were sitting on positions with roughly $25,000 of margin posted per contract. That was the cost to play. That was manageable. Then CME raised the margin to 11%. Overnight, that same position now required $66,000 of margin, not $25,000, $66,000, more than double overnight. And here's the brutal reality of leveraged trading. If you don't have the cash to post that additional margin, your position gets force liquidated automatically. No warning, no grace period. The system sells your contract at whatever the current market price is. And if the market is already falling when your margin call hits, your contract gets liquidated into a falling knife. So what happened on Friday was this. CME raised margins. Speculators who were over-leveraged couldn't post the additional capital. Their longs got force liquidated. Those forced liquidations pushed the price down. The price dropping down triggered more margin calls on other speculators. Those margin calls triggered more liquidations, and the liquidations pushed the price down further. A cascade, a waterfall, a controlled demolition. And at the very bottom of that cascade, when every weak hand had been flushed out, when the price hit $78 and there was nobody left to sell, that's exactly when JPMorgan made its move. JPMorgan's February delivery data shows them issuing 633 silver short contracts at Friday's settlement price of $78. 633 contracts. Closed at the exact bottom. Think about that for a second. The biggest bank in the world covered a massive short position at the precise moment the price hit its lowest point of the entire crash. Not before, not after. At the bottom. That is not coincidence. That is not luck. The data suggests that JPMorgan was buying from forced sellers, from the very speculators whose margin calls created the crash in the first place. They engineered the liquidation. They waited for the price to reach the lowest possible point, and then they stepped in and absorbed the metal at a discount that retail investors will never see again. Meanwhile, on the other side of the planet, physical markets told a completely different story. While COMEX was being smashed to $78, physical silver in China and India refused to participate at any price below 100. Shanghai premiums hit 43% above COMEX, 43%. Physical holders in Asia didn't panic. They didn't sell. They held. Because they understood something that the retail traders on COMEX didn't. The paper price in New York was not reflecting physical reality. It was reflecting forced liquidation. It was reflecting a margin squeeze, not fundamental value. That is the metals side of this weekend, and it sets up something incredibly dangerous for remaining shorts when we get to Monday. But that's metals. Now let's talk about what happened when crypto followed metals off the cliff. If you're seeing the full picture unfold here, subscribe right now. Because what I'm about to show you next is the connection between Friday's metals crash and Sunday's crypto massacre that mainstream media isn't drawing. Saturday and Sunday, crypto got destroyed. $500 billion wiped from the total crypto market cap in 72 hours. Bitcoin smashed below 79,000, down 13%. That's $265 billion evaporated from a single asset. Ethereum dumped 25%, 91 billion gone. XRP fell 22%. SOL crashed 23%. Everything bled. Now, the question everyone is asking is simple. Is this contagion? Did the metals crash on Friday spill over into crypto on Saturday and Sunday? Or is this something else entirely? Let me show you the data, because the data points in a very specific direction. Over the last 12 hours alone, there were 3 distinct liquidation waves in crypto. 3, not one continuous sell-off, 3 separate, well-defined waves. The first wave hit and cleared a chunk of leveraged longs. Then the market stabilized briefly. Then the second wave hit, stabilized again. Then the third wave came and finished the job. Those 3 waves combined liquidated approximately $1.3 billion in leveraged positions in 12 hours. And the total liquidation over the full weekend hit $2.51 billion. To put that in context, let me compare it to every other major liquidation event in crypto history. The October 2024 crash produced $19.1 billion in liquidations. The Terra Luna collapse triggered $1.2 billion. The FTX collapse liquidated $1.6 billion this weekend, $2.51 billion. This is the 10th largest liquidation event in the entire history of cryptocurrency, and it happened the weekend immediately after the biggest metals crash on record. Connect the dots. Now let's talk about Michael Saylor and strategy, because this is a thread that could pull the entire crypto market down with it if it breaks. Strategy, formerly MicroStrategy, currently holds 712,647 Bitcoin. That position is worth $55.72 billion at current prices. They acquired all of it at an average cost basis of $76,038 per coin. At Bitcoin's peak of $126,000, that same stack was worth $81 billion, even though they held 70,000 fewer coins at that point than they do now. The price alone inflated the value by tens of billions. But right now, with Bitcoin below 79,000, Strategy is sitting at just 1.8% above break-even on its entire Bitcoin holdings. 1.8%. That's a margin so thin, it barely exists. If Bitcoin drops below $74,600, Saylor goes underwater. The entire Strategy Bitcoin position turns red. And here's why that matters beyond just one company's balance sheet. Strategy is the largest corporate Bitcoin holder on the planet. Their position is a psychological anchor for the entire market. When retail investors and even some institutional traders evaluate whether Bitcoin is safe, they look at Strategy, they think, if the biggest corporate buyer is still profitable, the thesis is intact. But if that anchor flips red, if every headline on Monday morning reads, Saylor goes underwater, that's not just a data point, that's a sentiment bomb. It gives every remaining Bitcoin holder a reason to ask whether the institutional thesis is still holding. And fear spreads faster than logic. Now let me show you the other thread pulling at this weekend's destruction. Because crypto and metals didn't crash in a vacuum, they crashed while the world was staring at something else entirely. The same weekend, $15 trillion disappeared from markets. The media flooded every screen with 2 stories. Epstein files, World War III. Epstein documents dominated headlines for days. Every news outlet, every social media feed, every conversation shifted to Epstein. And simultaneously, Trump announced the deployment of troops and warships toward Iran. Qatar's foreign minister arrived in Tehran carrying what was described as a final message from the United States to Iran's supreme leader. So here's the question that nobody wants to ask out loud. $15 trillion evaporated. It doesn't just vanish into thin air. Markets aren't a black hole. Money doesn't disappear. It moves. It transfers from one hand to another. While everyone was watching Epstein and watching warships sail toward Iran, someone was on the other side of those trades. Someone collected that $15 trillion. The data suggests markets aren't just manipulated, they are rigged. And the timing of the distraction suggests this was not accidental. But there's one more thread. One more domino that fell this weekend that tells us exactly how fragile the system actually is, and it happened quietly. Most people completely missed it. Subscribe if you want to see what mainstream financial media is deliberately not connecting, because the next piece of this puzzle changes the entire picture. The first U.S. bank failure of 2026, Metropolitan Capital, gone. The first bank to go underwater in over 7 months. And it happened the same weekend $15 trillion was being ripped out of every other asset class on the planet. Now, is one bank failure significant? In isolation, maybe not. Banks fail. It happens. The FDIC steps in, depositors get made whole eventually, and life goes on. But this isn't isolation. This is context, and the context matters enormously. Let me take you back to 2008, because the pattern is identical. In the early stages of the financial crisis, it wasn't the big banks that failed first. It was the small ones. Regional banks, community banks, banks that nobody had ever heard of. They quietly went under one by one while the mainstream media was still talking about housing prices and consumer confidence. The small banks were the canaries in the coal mine. They were the first to feel the pressure of tightening liquidity, rising rates, and deteriorating loan books. And by the time the big banks started failing, by the time Lehman Brothers collapsed and Bear Stearns was absorbed, the small banks had already been screaming for months. Nobody listened. The result? Trillions in wealth erased. Millions of families crushed. The largest financial crisis since the Great Depression. Metropolitan capital failing in January 2026 is that canary. It tells us the system is under stress. It tells us that liquidity conditions are tighter than the headlines suggest. And it tells us that the margin of safety across the banking sector is thinner than regulators want you to believe. Some prominent analysts have started suggesting we could see more banks, more hedge funds, and more crypto exchanges collapse as these market conditions continue to tighten. Only time will tell whether Metropolitan Capital was isolated or whether it was the first domino. Now let me put all of this together. Friday, metals crash, $7 trillion gone. JPMorgan covers shorts at the bottom. Saturday and Sunday, crypto collapses. $251 billion liquidated. Strategy teetering on the edge. The same weekend, first bank failure in 7 months. Iran tensions escalating with troops deployed. Media flooding screens with Epstein and WW3. $3 trillion was knocked out in a matter of minutes at one point during the liquidation cascade. This wasn't normal market fluctuation. $3 trillion in minutes. That's a raid. That's systematic extraction. And where's the SEC? Where's the CFTC? Where are the regulators who are supposed to be watching this market in real time? The system is infinitely more fragile than they admit. And most people, most retail investors sitting at home watching CNBC, are completely unprepared for what this level of system stress actually means for their portfolios. So now, the question that matters, the question that determines everything that happens next. What does Monday look like? There are two scenarios, and I'm going to walk you through both of them in detail, because both are possible. Both have supporting data, and the difference between them could mean the difference between this being the bottom or the beginning of something much worse. Bearish scenario first, because if this is going sideways, you need to understand exactly how far sideways it can go. If what happened this weekend is the beginning of a full-blown liquidity crisis, not just a metals event, not just a crypto event, but a system-wide contagion spreading from asset class to asset class, then Monday could be significantly worse than anything we saw on Friday or Saturday. Here's the sequence. Asian markets open first. Tokyo, Shanghai, Hong Kong. If all three gap down hard at the open, and given that Shanghai silver premiums are already at 43% while COMEX collapsed, there's a real possibility of violent repricing. That sets the tone for everything that follows. European markets open next. Frankfurt, London, Paris. If Asia gapped lower, Europe follows. The selling pressure transmits across time zones like a disease moving through a body. Each market that opens lower gives the next market permission to sell. Then US markets open. And if both Asia and Europe have already cratered, the psychological damage is done before the bell even rings in New York. On top of that, more crypto liquidations are likely if traders wake up Monday morning to overnight losses and panic sell. More margin calls across every leveraged asset class. And if Saylor goes underwater, if Bitcoin breaks below 74,600 and Strategy's position flips red, that headline alone could trigger another wave of selling. If more bank surface is being in trouble after Metropolitan Capital's failure, if there are emergency weekend meetings, if the FDIC starts making calls, confidence cracks further. The flight to cash accelerates. Everything gets sold. Liquidity dries up even more. And the Iran situation hangs over all of it. If there's a military incident over the weekend, a strike, an escalation, anything that pushes the tension from diplomatic to kinetic, Monday opens with pure panic. Oil spikes. Risk-off dominates every market on Earth. In that scenario, the 15 trillion that was erased this weekend could expand to 20 trillion. 30 trillion. The cascade doesn't stop until something breaks it. And here's the part that's critical for anyone holding precious metals. In the initial phase of a liquidity crisis, phase 1, everything sells, not just risk assets, everything. Gold and silver get hit too, not because they've lost value, but because people need cash. They sell whatever they can sell to meet margin calls, to cover losses, to raise liquidity. We saw this on Friday. Silver is supposed to be a safe haven. but it dropped 31% because safe haven demand, the bid that comes when people flee to gold and silver for protection, that's phase 2. Phase 1 is pure liquidation, and phase 1 can last days, in extreme cases weeks. CME could raise margins again on Monday. More forced selling in metals, more liquidations. The paper price on COMEX could drop further even as physical premiums in Shanghai continue to explode. We're already at 43%. If COMEX drops more while Shanghai holds or rises, that premium could hit 50%. At some point, the COMEX pricing system loses all credibility as a reflection of physical reality. But getting there, surviving the paper collapse before the physical reality reasserts itself, could be extremely painful for anyone holding leveraged or paper positions. That's the bearish Monday. Now let me show you the other side, because the bullish case is equally supported by data, and it tells a completely different story about what this weekend actually was, the bullish case. And this is the scenario that, if correct, means this weekend was not the beginning of a crash. It was the end of one. If JPMorgan and other large banks successfully covered their short positions at Friday's bottom, and the delivery data strongly suggests they did, then there is significantly less short interest left to suppress the next move higher. The sellers who were actively pushing the price down have exited. They got what they wanted. They're gone. Physical holders in China and India refuse to sell at $78 to $90. They're holding firm. Delivery demand for February remains at 2,514 contracts. Physical supply is tight, tighter than it's been in years. So if Asian markets stabilize Monday morning, if the liquidation stops, if margin calls ease, the setup for a violent snapback is already in place. Shorts covered. Physical is tight. Shanghai premiums at 43% are screaming that the paper price in New York is completely disconnected from what physical metal actually costs in the real world. The rebound, when it comes, could be fast, and it could be brutal for anyone still short. We've seen this exact pattern before. Massive flush, violent, terrifying, headline-grabbing destruction. Then explosive recovery. The flush isn't the end, it's the reset. It's the mechanism that clears out the weak hands so the next leg can begin clean. China's export controls that went into effect January 1st are still crimping global silver supply. India absorbed 25% of total global production in 2025 with completely inelastic demand, meaning they bought it regardless of price. The physical fundamentals underneath this market haven't changed. If anything, Friday's crash made them more extreme. If the paper liquidation is finished, if the weak hands have been flushed out completely, then the path back toward 100 and beyond reopens with far less resistance than before. Mining stocks in particular could see dramatic moves over the next 4 to 6 months as the market reprices the structural deficit. Now, crypto. If the 3 liquidation waves totaling $1.3 billion cleaned out the overleveraged positions, and the data suggests they did the bulk of the damage, then Monday could see a stabilization. If Bitcoin holds above 79,000, if Sailor doesn't go underwater, if no new shock arrives overnight, the herd sentiment can shift back from extreme fear to cautious optimism remarkably fast. We've seen it happen in 48 hours before. Liquidity returns, prices recover. The same crowd that was panic selling on Saturday starts buying the dip on Monday. And Iran. If the message Qatar delivered to Tehran leads to diplomatic progress, if there's no military escalation over the weekend, if diplomacy prevails over kinetics, then the geopolitical risk premium that got priced into every market this weekend starts coming out. Risk on returns. Assets rebound across the board. And here's the piece that ties it all together, the kicker. If this weekend was deliberate manipulation, and the data points strongly in that direction, then JPMorgan exiting at the bottom, $15 trillion evaporating, while the media keeps everyone looking elsewhere. The margin hike creating the exact conditions for forced liquidation, if all of that was planned, then the manipulators are done. They achieved their objective. Weak hands flushed, shorts covered, positioning reset. Now they let it run. Now the next leg of the bull market begins. Monday could open green across every asset class. But here's the honest truth. Both of these scenarios are possible. Both have real data supporting them. The market doesn't come with a label telling you which scenario you're in. So here's what I'm watching. The 4 signals that will tell us which Monday we're getting. Signal 1, Shanghai futures. They open Sunday night our time. If Shanghai silver holds firm or rises while COMEX is closed, that tells you physical demand is not panicking. The Asian bid is intact. That's bullish for Monday. If Shanghai gaps down hard and follows COMEX lower, that tells you the selling pressure has gone global. It's not just a US margin squeeze anymore. That's bearish. Signal 2, Bitcoin over the weekend. If it stabilizes around 79,000, holds that level, maybe even bounces toward 82 or 85. That's bullish for Monday's risk appetite across the board. If Bitcoin breaks below 75,000 and Sailor goes underwater, That's a headline that triggers another wave. Bearish. Signal 3. Iran news. Any military strikes, incidents, escalations over the weekend? Bearish for Monday. Any diplomatic progress, de-escalation, movement toward a deal? Bullish. Geopolitical events move markets instantly when tensions are this elevated. Signal 4. Bank news. If more bank surface is being in trouble, if there are weekend emergency meetings, if the FDIC is stepping in anywhere else beyond metropolitan capital, that's bearish. If metropolitan capital was truly isolated, if no other banks are showing signs of stress, confidence holds better. Watch those 4 signals. They will tell you which scenario Monday is playing out before the first bell rings. 3 takeaways, and then we're done. Number 1, $15 trillion was erased from gold, silver, and crypto combined in a single weekend. The metals crash on Friday triggered the 10th largest crypto liquidation in history on Saturday and Sunday. This is not normal market volatility. This is system-level stress. JPMorgan exited their shorts at the exact bottom on Friday. The question for Monday is whether the liquidation is finished or whether it's just beginning. Number 2, the physical paper disconnect is at extreme levels. Shanghai premiums at 43% while COMEX collapses. Physical holders in China and India refusing to sell at any price. February delivery demand at 2,514 contracts. If JPMorgan covered their shorts and physical supply is this tight, the rebound setup is dangerous for anyone still short. But if liquidations continue Monday, paper could drop further before physical reality forces a correction. Number 3, multiple catalysts converging simultaneously. First bank failure in 7 months, Iran tensions with troops deployed and final messages being delivered, media distraction, flooding screens with Epstein and WW3, and $15 trillion transferring hands while everyone was looking the other way. The unresolved tension is this. Was this weekend the final flush before a major bull run resumes? Or is it the beginning of a systemic crisis that makes 2008 look manageable? JPMorgan exiting at the bottom suggests manipulation, a planned flush. Clean the weak hands, cover the shorts, reset the board. But 15 trillion erased, a bank failure, Iran on the edge, crypto cascading, that looks like something bigger breaking, something that might not be controlled. Monday's open will tell us which scenario is real. Do your own due diligence. Understand your risk. If you're overleveraged in anything right now, metals, crypto, equities, this environment is a liquidation machine. Margin calls don't care about your thesis. They don't care about your conviction. They care about your cash. But if you're positioned appropriately, if you understand what's happening underneath the headlines, Monday could be either the opportunity of the year or the start of something that rewrites everything. Stay sharp. Watch the data. The next 24 hours will tell us everything. Mark from GoFinance. Subscribe if you want analysis that shows you what's actually happening behind the price. This isn't the end of the story. It's the middle. And the next chapter opens Sunday night.